Hello everybody, my name is Craig Bennett, and today I am going to get into a video in the stock market, and this one is getting into margin loans. Now in the previous video I got into margin accounts, and the thing that you got to note is margin loans, you don't have to use them when you have a margin account. However, it is something that you need to note, especially if you're going to have a margin account. Why would you have a margin account? Short stocks and do a few other things, so note that. Now, as far as a margin loan, what is it? A margin loan is a loan that is only used to sell and buy stocks on the market. It gives you increased buying power so you can get an increased amount of money back. Simple as that. So as far as margin loans, depending on what you're buying and selling is depending on how much you actually need to have in your account in order to get the margin loan. But let's say, for example, you are trying to buy a stock for $10 per share and you're wanting to buy $10,000 of shares. In order to buy $10,000 with using a margin loan, you would actually need to have $5,000 in the account, $5,000 in cash in the account. And this means you need to have 50% of the total value of whatever you're buying in the account for the stocks wise. Now, as far as that goes, the firm can tell you for requirement purposes that you need to have more or less in the account on top of that. That's really up to the firms itself. But as far as a general rule for legal purposes, you need to have 50% of whatever the total value, and then the firm can add on saying, well, you need to also have cash in the account up to more or less, so you need to have extra cash in there to actually, not get messed over by this. So why would you want to do this? Well, let's say, for example, that you wanted to buy that stock. It's $10 per share. You only have $5,000, or you're willing to only put down $5,000 of your own money. So with that $5,000, if that $10 per share goes up by $1, then you gain $1,000. So that $1,000 increase your portfolio by 20%. Now the math might not seem right there, but think of this. You only put down $5,000 and that went up by $1,000, which is 20%. However, if you put down $10,000 and that went up by $1, which would have been $1,000, then it only went up, your portfolio went up by 10%, given that that's your entire portfolio, obviously. So that's something to keep in mind, is you can actually get more money with less. However, this might sound like a great thing, and this is what the firms don't tell you, and this is where some people get messed over with. What happens if the stock goes down? This is fairly important, because just like there's a 20% increase that you got there versus 10% if you just put down a full 10,000, you can actually go down, if it goes down $1, then it's a 20% decrease in that. Whereas if you put down the full 10,000 and went down $1, even though you now have a total of $9,000, you basically have a 10% decrease. It's fairly important to note that the firms itself, since you borrowed $5,000, whether you lose majority of the money or gain a whole bunch, they're getting that $5,000 back. No matter which way you look at it, they're getting it back. So this is fairly important because firms have the ability to liquidate your assets in order to get their money back. Now, it's possible that they might not notice or something else happens and it goes too far down and it goes below what you owe them. So what this means is they can liquidate your assets and puts penalties. So you would actually have to fund your account in order to get things back to normal, to have again a healthy relationship. Because the thing is, it's a loan. That's the thing that you gotta keep in mind. It's not a handout or hand up or anything like that. It's a loan. Now, with that in mind, if you say, for example, borrowed $10 and the stock looks like it's going to go down below whatever you can pay back, including the entrance, they would tend to liquidate before then. But say, for example, if it just dropped below from $30 to $9 and that caused a problem, well, the thing is they can you can negotiate with them to get a little bit of leeway there, but for the most part, that they're going to want their money back pretty badly because they're a business. They're not a charity. So with that one in mind, you also have to note that there's entrance into it. Now, depending on the firm is depending on how much is the entrance. This is fairly important to note because this could be quite a bit or not much at all. It could be a few cents or a couple $100 depending on how much you're trading and the entrance into itself. Because of that, because the firm has a strong grip on this, because of how complex this is and because of the risk behind this, because like I said, if the stock goes up and hypothetically if they'll gain you 30% versus whatever you had if you used your own money, what the fact of the matter is you can lose that. If you mess up, you can lose more money by using this. If you don't know what you're doing, you can easily lose more money than not using this. I always advise, unless if you absolutely know what you're doing, stay away from margin loans. It's not a thing that is a death sentence to account. And let's say, for example, if like that $5,000 situation, if, for example, you borrowed $200 or something like that, that's probably not going to be a problem at all. However, if you have that $5,000 situations, it's, for my sake, I'll say it's moronic to borrow $10,000. Even though you might gain that 20% increase versus whatever you had by just using $5,000 or $10,000 of your own money, the fact of the matter is there's just way too much risk right there. It's also important to note that depending on the firm is depending on how they treat all these things, but it generally it can get pretty nasty if you start losing money pretty quickly. Some firms are a little bit nicer, some firms are a little bit more lenient and whatever, and more understanding. And also on top of that, some firms will work with you, but some won't. And even if they work with you one day, tomorrow they might not. So you might say, well, I have a good relationship with my local office or from the firm itself or whatever it may be, but tomorrow might not be that way. They're a business. They're not a charity. Keep that one in mind. But as far as that goes, I figured it's worth mentioning it because you probably will come across it. And it's fairly important to note with the entrance rate because that can also mess you over since on top of the commission that you would have to pay, you also have to pay the entrance rate. And if you're just making it barely above the commission fee, then this would actually set you under, potentially, depending on how much the interest rate is. But anyways, as far as that goes, hope that you like this, and I'll see you next video. Hope you have a great day.